Good morning.
Morning.
So welcome to our first class, more or less. And you see that we're going to go straight to our first topic, okay? And the first topic is more towards an introduction, okay? Trying to introduce yourself to the concepts of financial management and what finance is all about, okay? Of within the scope of the syllabus, of course, okay? So that's what we'll be discussing in this particular introductory topic, okay? My camera, however, I'm not sure what the problem is. I've not been able to sort it out, but of course I will see how we can do it. So that, as I mentioned, the idea is that at least you see me, you don't just hear my voice, okay? At least for the first class, that is. But I have an issue, so I hope I'll sort it out. So the first topic, okay, is simply an introduction towards financial management, okay, to try to introduce ourselves. What do we mean by finance, okay? What is the scope of financial management, okay? And as I mentioned, don't forget, whatever we shall be discussing here will form the basis upon which we shall be discussing in the preceding topics, okay? Because that's my email address, okay? And I think you also have my phone number, okay? So in case you don't want to communicate something, you are free to do that, okay? And by the way, before you even go ahead, okay, so as I had mentioned, just to re-emphasize, we shall be having rats, okay, not ratters. So it's just an assessment at the end of every topic that we shall be discussing. We do some questions, okay, some MCQs online from the e-learning. And as I mentioned, the key purpose of them is to us to make an evaluation of whether you understood the concepts or not, okay. So in case, as I mentioned, it acts as a guide, okay? So there's no need for you to copy, because you can get the answers for sure, but there's no need for you to copy, okay? It's for your own assessment, trying to see whether you understood or didn't understand the concepts, okay? So the idea will be, so at the end of topic, for example, if you're done with topic 1, okay, we agree together in class that maybe the next class or the next class but 1, we shall do some multiple choice question based on that topic, okay? That's what we shall be doing, okay? Then once in a while, shall be doing the structured question, okay, to help us be able to appreciate, okay, how the section C type of question will be like, okay. So on the e-learning also, there are question bank which I've already posted there. So we shall be going through them together, okay, trying to understand the examiner well, okay. And if I remember, the e-learning had an issue in the morning, so let me see whether the issue is over. Yeah, it is. So actually, let me share with you the e-learning. Okay, so of course, to go to the e-learning the normal way. Okay, so elearning.strathmore.edu. Okay, you log into the site. Okay, your username, your password. Okay, so log in. My password is expired. Oh, let me know whether I can remember my password. Wow, I've forgotten my password. So, any one of you can go to log in from your end. Brian, you can?
Yes, I've been able to log in.
Okay, fair enough. Let me give you permission to share so that I take it so that I can use your screen for the rest of us.
Okay.
Let me see how screen share. More participant. Yeah, try now, Brian. Try to share your screen.
Okay, see it.
Yes, we can see it. Okay. If you check on Strathmore University, click on the Strathmore University. Yes, up there. You know, e-learning. How do I do e-learning? No, actually, just try on the. Can you see the logo for Strathmore University? Yes, you click on it. Okay, scroll down. Okay, School of Accountancy, Strathmore Institute. Yes. Scroll down. Okay. ACCA. Okay, scroll down. Full time. 2B. Okay, so as you can see, okay, you have a number of financial management courses there. So one of them, like, okay, I'll show you. Like, for example, you have just where, can you see this? Just post there, post there, post there. You can see this OTQs, financial management, okay, that is mean objective, don't click on it. This that mean objective test question, okay, which we shall be using for our online multiple choice questions, okay. So we shall be using it for our online. It is not so, what can I say? I have not yet increased the number of questions, but I'll do that as time goes by so that you can have a number of questions. Because the questions that are there are too few, like 10 per topic, 20 per topic, which is too few, okay? So I'll try to revamp it to have more questions so that we can have like a comprehensive BPP Kaplan question in it, okay? Either way, we shall do it that as time goes by. If we check down there, you can see financial management F9 full-time that has a key. Financial management, the one that has a key, okay? So the one that doesn't have a key is not for our course. So the one that has key is for our course there, okay? You can see 3 lecturers there, okay? So the key, it is asking you for a key there, okay? It should be ACCA, small letters, ACCA. I hope all of you, it's ACCA, small letters, F9. Yeah, so enroll me. Yeah, so, and there are our notes. So the key is ACCA F9, all small letters, ACCA F9. So our notes from the first topic all the way to the last topic, okay? We are already on that particular site, okay? From the first topic to the last topic, so they're already there, okay? So that will be the notes. I'll be using those notes, okay? They are a bit summarized, okay, definitely. But they're more than enough, okay, to do our own analysis. They're more than enough, okay, for our own consumption. Yeah, so that's on the e-learning. You all got it. Collins, Anita, and Sanya, you all got how to navigate through?
Yes.
Okay. Anita?
Yes.
Okay, Sanya?
Yes, I got it.
Okay, great. So that's where we shall be using. So even the question bank, for example, you can see the question bank. You can click on it, okay, just to download the question bank. Yeah, so this is questions from past papers, okay? Actually, they run all the way to from 2007, okay? And most of you are still very young, okay? So they run from all the way to 2007. The reason as to why I have given you bulk question is for you to practice, okay? In most of it or not, finance is not going to, it doesn't change that too often. So the question that you see that were done in 2007, okay? Like the first question is for 2007, okay? All the way to the latest, okay, should be like last sitting, okay, for much of this year, okay. So all questions I've compiled them into one question bank, okay. This is what I shall be using, and the question we shall be seeing here, most of them are type C question, okay, because in the old way, the examiner used to give entirely type C question, okay. So we shall be using it for assignment, and we shall be using it for our own, okay, class discussion, okay. So I'll be making reference to that particular question bank, okay. So I hope you can go to download it because I'm making more reference, okay. Thank you, Brian. That is it. Thank you. You can stop share. Thank you. Okay, thank you. So that's how we shall be using to log into or to access our notes. Okay. As I mentioned, they're best summarized, but they're enough. Okay. They're best summarized, but they're enough. Actually, in case you come to class, you don't even need to go through the BPP textbook. Okay. If you just come to class. Okay. But if you want more for sure, you can make reference to the BPP. Okay. Anyway, so the first topic is about trying to make an introduction towards financial management. Okay. And financial management, okay, in simple terms, what do we call it? As the name is suggesting, managing of finances, okay, financial management, okay. So financial management is the managing of company finances, capital, funds, financial resources, okay, with the key purpose of achieving the company, or assist the company to achieve its objective, okay. So you managing the company financial resources, okay, and they include even assets. So the money company resources, financial resources, okay, with the key purpose of achieving the company objectives, okay. That's referred to as financial management. In simple terms, okay, management of finances. What is the purpose? To achieve the company objective, okay, to achieve the company financial objectives, okay. That's all referred to as financial management, okay. Which means, therefore, from the definition, which will be discussed, therefore, what constitutes, therefore, financial resources? What constitutes, therefore, financial capital? Okay, so what constitutes financial objective? Okay, so we shall make a reference to those terms in the particular topic. Okay, to know what exactly, therefore, okay, does financial management therefore entail? And the financial management entails three things, okay, what we call the scope of financial management. So there are three things that essentially, okay, we can search defines, okay, what we can call financial management, okay, what defines financial management, okay. So the first thing is what we call financing decision, okay. Then you have investment decision, and you have what we call the dividend decision, okay. Financing, investment, and dividend decision, okay. Now, what does the financing decision entail? Okay, the finance decision, as the name is suggesting, is about financing. It's about obtaining money. Okay, trying to determine, for example, where will the money come from? Okay, you have a project that is going to cost you 10 million. Okay, you therefore, as the finance man, you as in charge of fundraising for the company, you have to know, okay, where are we going to obtain the money from? Who is going to be the financier? Okay. Next, you have to be able to quantify what is going there for the cost you be incurring. Okay, what's the cost to the business? Yes, the bank is willing to give you money. Okay, $10 million. Okay, great. But at the end of the day, okay, you can't just accept the money. It has to be justified. Okay, you're getting $10 million. Okay, but because of A, B, C, and D, we want finances for the project. Okay, these are the returns that you're going to be received from it. Okay, which is part of the investment decision. But this is all the return that the different provider of capital expect to get. Okay, the bank has given us $10 million. Okay, but how much return does the bank want out of the $10 million they have given to us? Okay, you need to justify that decision. You need to justify why the company should use equity financing as opposed to debt financing, or why the company should use debt financing as opposed to use of equity financing. Okay, that will be as a financing decision. Should you use long-term or should you use short-term? Should you use an overdraft finance to finance this company need, or should you use bonds issue? Okay, that should be at a financing decision. In the case of the investment decision, as the name is suggesting, it's about the investment, it's about the company capital projects, okay, company long-term investments, okay. The company want to buy a machine, okay, so you need to make analysis, okay. First of all, how much cash inflow is this machine going to bring to the business? Okay, in year one, how much do we get? In year two, how much do we get? In year three, how much do we get? Okay, so quantifying the amount of cash, okay, that this particular investment is going to bring to the business. Okay, at the same time, of course, quantifying, of course, the amount of cash outflows. Okay, if, for example, this machine is going to be a production machine, okay, it is going to move in production of commodities. Okay. Yes, will be cash inflow, for example, from the sale of the commodity that has been made by the machine. But at the same time, you've been carrying some costs. You need to buy raw materials. You need to pay the wages. Okay, you need to pay for the overheads. So there's so many other things, okay, that you need to incur, okay, to earn that money. Okay, therefore, when it comes to the financing decision, the appraisal of the investment, the appraisal of the project, you also quantify the cash outflows. Okay, the money out of the business because of that particular investment which we did choose. Okay. Then you have the dividend decision. Okay, we have called the dividend decision. The company belongs to the shareholder. Okay, don't forget the company belongs to the shareholders. So as shareholder, therefore, they want to return at the end of the year. Okay, this is our company. This is how much we have as a shareholder in this particular company. This is our equity investment beginning of the year. So at the end of the year, we are going to make an evaluation. Did we achieve what was the target? Okay, how has the company been performing over that particular one financial year? So the managers have to account to the shareholder. And one of the account to the shareholder is by if the company has made profits, okay, and the company prefers to pay the dividend, then payment, the distribution of the company earnings, the shareholder, okay, is what referred to as the dividend, okay. So you as the managers, you as the executive, they have to make a decision regarding how much do you pay as form of dividend, why do you pay the dividend, okay, because you need to justify, okay, why you're paying the dividend. As you see in finance, but not in finance, in management, actually, okay, we normally say that every decision that the shareholders, the managers are making, okay, ought to be geared towards achieving, okay, it ought to be geared towards achieving the company objectives. Every decision you're making, okay. So this includes even the dividend decision, okay. It need to be we need to see the connection between paying this dividend and the company achieving its objective, or for example, maximizing the shareholders' wealth, for example, okay. So it need to be a connection. So that will be under the dividend decision. When to pay, why to pay, okay, how much to pay, okay. So all of that is contained under the dividend decisions, okay. Anyway, let's begin with financing decision, okay. As I mentioned, at the financing decision, it's more about finances, okay? Trying to know, for example, where are we going to be obtaining the money from, okay? Who is going to be our financier, okay? Trying to know where is who are the best provider of capital to us as a company, okay? Identify the capital with the lowest cost, okay? Don't forget, as managers, you are stewards, okay, of the company. So you cannot just go to and finance yourself using the most expensive financing source, okay? That should not be stewardship, okay? That is going to be commanship, okay? So of course you need to look, okay? Debt capital is going to cost us 10 million, okay? It's going to cost us 10 million per year. But why do we need to finance debt? Why do we want to use debt capital? Whereas if you have to use equity capital, the cost of the business would be 9 million, okay? So you need to also identify the capital source that are going to be having the lowest cost to the business, okay? As I mentioned, you as managers, you are stewards in the business, okay? Then of course, you need to justify, as I mentioned, between the short term and the long term. Which do we use? Should we use long term? Should we use short term? Okay. One of the key criteria, okay, we shall discuss as time goes by, and a business finance topic, we shall say that you have one of the concepts that I don't want to use is called the matching concept. Okay, the matching concept. Okay, it's called the matching concept. Okay. Okay, the matching concept. Okay, in matching concept, what we normally say that if you're going to have an investment whose life is, let's say, 3 years, okay, it's worthwhile that you look for a finance source that is going to be maturing within those 3 years, okay. If you're going to have an investment need, or the need for capital is for only 2 months, you cannot issue equity to finance the need for 2 months. It makes no sense. So if the need is going to be for 2 months, then look for a capital source that is going to maturing within those 2 months, okay. Why is this good to do that? Okay, it is good to do that because if the cost of capital, okay, need to be financed by the cash flows from the project, okay. That if you're going to be using a bank loan, then the interest you pay to the bank, the interest needs to come from what you're making from the project. So in case the project has a life of 1 year, and you use a 10-year loan, it means therefore for an extra 9 years, you will not be having money. I don't know whether my point is clear. Let me see if I can get my writing area. Okay, give me a second. I get my writing area. Okay, got it. If, for example, we have an investment whose life is going to this project, okay, that has a life of 1 year. Let me call project A, its life is 1 year. Okay, it is better that you finance it with a 1 year financials. Okay, let me give you a 1 year loan, for example. Okay, such that the interest you pay on the loan, the interest you'll be paying on this loan, okay, will be matching with the receipts you'll be receiving from the project. Okay, such that by the time the end of the project comes in, you have already been able to pay off the interest. Okay, so it's 1 year, 1 year. So it does not make any finance sense, okay, or even economic sense, okay, if you're going to have a project that has a 1 year life, okay, and you finance it with a 10-year loan. Why? Because this investment its life is going to come to an end, okay, in the year 2021, for example, okay. However, this loan you will pay until year 2030. That means, therefore, in the year 2022 all the way to year 2030, don't forget you're paying interest on it. However, the interest you're paying here does not match with the receipt because the project came to an end in year 2021. Okay, that we refer to as the matching concept. This interest here do not match with the receipt from the project. Okay, because it's no project. Okay, so it's better that you do apply what we call matching concept. Okay, so try to observe, try to see what is the life of this project. Okay, what's the life of the project? Okay, so you try to match it with the life of the finance source. Okay, the maturity of that finance source. Okay, clear, Anita? It's clear. Okay, so that's the decision you need to make regarding financing decision. Okay, then the other thing you need to make regarding financing decision, of course, is to be able to establish what we call an optimal mix of the different finance sources. Okay, there's a topic we shall discuss it alone. Okay, under business finance. Okay, called the capital structure theory. It's called the capital structure theory. Capital structure theory. Okay. Now, this theory, what do they say? That at the end of the day, there is what we call an optimal target point. Okay, that if we are to mix debt and equity, okay, so the key assumption we want to make is that the two key financials of the business are equity and debt. Okay, let me just share my writing area. Okay, if for example you have a business here, okay, this is the current capital structure, and capital structure is simply how has the company financed itself, okay? How much of equity has the company used? How much of debt has the company used, okay? If, for example, the company currently, its assets are financed by, okay, debt, equity, okay, where debt is, let's say, 10%, and the equity is 9%, ensure the equity finance the balance. Of course, to make therefore the entire finance need of the company 100%. Okay, so the idea is that at the end of the day, you can see this is 10%. So this you can say that how the company has financed its asset is what we refer to as the capital structure. So this is simply what we refer to as the capital structure, is how the company has financed its assets. Okay, so assuming this is the current capital structure, and the company has an optimal. Okay, by an optimal, okay, the idea is about here. Don't forget debt holders, okay, of the company, they won't return. They don't give money for free. Okay, there's no free capital. There's no free lunch in any economy. Okay, and if there is one, be careful. Anyway, okay, so that's debt and equity. Okay, so you have debt and you have equity. So the debt holders won't return. Shareholders won't return for the investment. Okay, so there's a cost attached to obtaining this finance. Okay, just for the case of argument, assume the cost is, let's say, 18% per year. Okay, 18% per year to be the cost of capital. Okay, so the optimal, okay, is going to, or an optimal capital structure exists if it is possible to reduce this cost by simply reducing or increasing one component, one capital component. If, for example, I increase the debt, okay, from 10% to, let's say, 30%, and that means therefore you decrease equity from 90 to 70%, okay, to give us therefore 100%. If the cost of capital is going to decrease, okay, assuming it's going to decrease from 18 to 11%, okay, per annum, and assuming it cannot increase any further, okay, even if you increase debt or you decrease equity, whatever it is, this is the bare minimum it can go, okay. Now, if this can happen, where the company can be able to reduce its cost by simply influencing the debt and equity, then you can say this is therefore an optimal capital structure. What do you mean by optimal capital structure? Okay. So you as a business, you have to know what therefore is our optimal. Okay. What is our optimal capital structure? So as we finance our investments, we are going to be paying attention. Are we moving towards the optimal? Okay. So if, for example, in this case, this is the current, okay, and this is the optimal, we can see that going forward, the company should finance themselves first using debt, because we need to increase the debt, okay, from 10% to 30%. So the company investment going forward should be financed more using of debt as opposed to equity, okay. That's a part of financing decision, trying to say, okay, what therefore is our current capital structure, okay. And we shall discuss in detail in that particular topic, okay, of capital structure theory, okay. Clear, Asanya?
Yes, I get it.
Okay, great. So all this will be part of the financing decision. They are all part of financing decision, okay? And of course, it is you, okay, as the consider that it is the role of finance manager to do that particular task, okay? So that's on the financing decision, okay? I know I've gone in detail, which we don't need to do at the beginning. Then you have to call the investment decision, okay? The investment decision. So the investment, okay, yes, you want to take out this particular investment. It's going to have a life of 10 years. Okay. First, you need to make analysis. Okay, as I mentioned, quantify. Okay, how much cash does this investment bring to the business? Okay, what is going to cost the business for using this particular investment, for buying this particular machine? Okay, so quantifying all the cash, in the financial benefits. Okay, and the financial costs that will come in case as a company we go ahead with this particular business. Okay. That's the cause about the other investment decision, other capital budgeting decisions. Okay. And of course, at the end of the day, when it comes to the decision, we need to make a decision. We need to, once you've done that financial analysis bit, okay, you've quantified, okay, the cash flows, okay, you've determined the value, okay, the different appraisal methods. Okay, for example, one of the methods we use is called the NPV, the net present value method. Okay, or even in case of return on capital employed. Okay, so based on the appraisal method we have used, okay, should the company go ahead with the investment? Okay, should the company go ahead with the investment? Okay, if for example, just look at NPV. So NPV actually, it's the excess of present value of cash flows. Okay, I know you've done present values already. NPV is the excess of present value of cash inflows over the initial investment cost. Okay, you spent 10 million. How much do you get back from this investment? 15 million. Okay, there was the NPV. It's 15 minus 10. Okay, so it's 15 million minus 10. There was excess 5 million. Okay. If the two are in present, they are as at today's value, okay? Therefore get a positive NPV of 5 million. So based on the rules of that particular appraisal method, should we invest for the NPV? Yes, invest. Because you're getting more than what you spent. By how much? By 5 million, okay? So all that is going to be done under the investment decision, okay? But don't forget, you need to see the connection between the decision, because the investment decision will have an influence on the financing decision. Don't forget, okay? That if, for example, we decide that this is a good investment for us to make, the next step is that where will the money come from? Okay, where will the money come from? Okay, then that's become part of the financing decision. Okay, so see the connection. They are not disjointed decisions. Okay, if anything, they are quite coordinated. Okay. The next decision, as we had mentioned, is on the dividend decision. Okay, you have mentioned the company belongs to the shareholder. The shareholders want a return on the investment. Okay, if there's no return you'll be receiving, would you want to invest? Okay, unless you have some other you have for-called behavioral finance aspects. Okay, you invest because you want to invest, not because you want to get money. Okay, it remains by the way, but you're assuming that you invest to make money. Okay, you even a shareholder. So, of course, therefore, you do want to make an assessment. If I invest in shares of Safaricom, how much return do they give to me at the end of the year? If I invest in shares of KCB, how much return are they going to give me by the end of the year? So that evaluation has to be there. Okay. So either way, for the company, executive, okay, finance manager being the key player here, okay, you have to make a decision. how much dividend do we pay to the shareholders, okay, at the end of the year? If you have made profit, okay, and it is upon the company policies of paying the dividend, then you may want to take a decision, okay? Out of the 100 billion we have made in terms of revenue, okay, the profit of, let's say, 50 billion, how much of the 50 billion we as Safaricom should we pay to the shareholder as dividend, okay? Well, you need, as mentioned, you need to justify why you're paying the dividend to the shareholder, because you may have cases where shareholders don't want the dividend. Collins, can that exist, by the way?
No.
Brian, can that exist?
I don't think so.
By the way, there are cases where, Sanya, before I answer, Sanya, do you think that can exist?
You're asking if directors wouldn't want dividends.
Shareholders will not want dividend.
I don't think so.
You don't think so? Anita, what do you think?
Unless it's
Seems unlikely.
Sorry. Anita, that was Sanya. Continue.
Oh, nothing. I was just saying that it's unlikely, but I'm not sure.
It's not quite unlikely. That was Brian. Oh, Brian?
I was saying maybe unless it's, I don't know, a small family-owned business
A small family-owned business.
where like they don't get the dividend. They don't get the dividends per se. They just get the profits immediately. Yeah.
Okay. Anita, what do you think? Let's hear your voice.
I don't think so. I'm not sure though.
So you don't think that the shareholders will not want to pay they won't pay the dividend?
Sorry?
You don't think shareholders would have that as an alternative for them not to get the dividend? They always want the dividend.
Yes.
Okay, generally, by the way, you can have cases. Okay, of course, for most we'll call individual investors. Okay, you and me, in case we have to go and buy in the stock market. Of course, you want the dividends. Okay, for individual investors, consider the dividend as referred to as supplementary income. Okay, so it is going to boost our, let's say, our cash flows. Okay, of course, we as the investors. Okay, however, we have investors who don't want to pay the dividend. Let me give you an example. The case of NSSF, okay? Don't forget, NSSF is one of the major investors we have, okay? NSSF, the National Social Security Fund, okay? So they give you through a simple math, okay? Why they don't want to pay the dividend. When does someone join the NSSF? Collins, when does someone join NSSF?
When they start working.
What age? For hypothetical cases.
When you start receiving a pension package.
At what age? Generally, when you
35 plus, 40.
No, when you get employed, that's when you start paying for the pension.
Okay.
So when do you generally generally join the workforce?
Mid-20s.
Mid-20s, let's say 25 or 20, let's say 24 years, okay? That's when someone gets employed in most cases, okay? For the case of the Kenyan economy, okay? So you start contributing immediately, okay? Not that when you reach that 5 and above, no, you start contributing immediately towards the retirement, okay? Through, for example, the monthly contribution to the NSSF, okay? Now, when do you retire? Because the payment don't occur before you retire. The payment will occur after you retire, because you're being paid the monthly stipend, sort of, okay? It occurs after you retire. So when do people retire? Generally, Collins, back to you.
60, 65.
The 65, that's the 60, okay? The 60. That means, therefore, okay, people join at 24, therefore they exit the plan, okay? Retire, this is a retirement plan, okay, at 60, okay? Therefore, which means, therefore, if we have to assume that the one who enter and the one who exit are equal in numbers, okay, the entry and the exit are equal in numbers, 50-50. There was the average age of the contributor. Sanya?
The average age of the contributor, isn't it?
Yes. Sanya, how do you get?
Sorry, my internet was unstable. Can you please repeat the question?
The question was, okay, if we have this, the people who enter the scheme, okay, they join at 24, they exit at 60.
Yeah.
And on average basis, the one who join and the one who exit, in terms of the numbers, they are the same. So the question was, okay, what's
Mm-hmm.
going to be the age of the contributors in this particular scheme?
The average age. 42.
42, yes, to be 42. Okay, yes, to be 42. But simply 24 plus 60 divided by 2 to give us 42. Therefore, the average. Thank you, Sanyan. Okay. Therefore, the average age of the contributors is going to be 42 years. Okay. Now, that means, therefore, when do the scheme, okay, let's say this NSF, when do they have a requirement to pay the money at the age 60, isn't it? Which means, therefore, how many years do they have to go before they pay? Brian?
18.
18 years. Okay, they have 18 years to go. Which means, therefore, if you are to pay the money today, do they have a need for money? Do they want to get the money today?